Every day, thousands of people across the country go out and look for a home for their growing family or as an investment for their future. But no matter what they find, they usually need a loan. In today's market, borrowers have several options to choose from: banks, direct lenders, or brokers. They usually make these choices without understanding the difference between them. For example, since banks use their customers' deposits to fund loans, they have a very limited number of loan programs and have very strict requirements to ensure that they don't put their depositors' money at risk. Banks usually limit their loan programs to conventional government loans and to borrowers with perfect credit or lots of liquid assets. On the other hand, direct lenders use warehouse lines to fund loans. You can think of a warehouse line as a credit card for funding loans. Since warehouse lines are not tied to a depositor, this allows direct lenders to offer more types of loan programs for different types of loan scenarios. Jumbo loans, bank statement loans, and hard money loans are just a few of the programs that direct lenders tend to offer. However, no direct lender offers every product for every scenario. That's where brokers come in. Brokers partner with several types of lenders so that we can provide our clients the best program possible. Since brokers partner with a variety of lenders, we can find loan programs that fit almost any scenario. We also shop our client scenarios to all of our lenders so that they can compete with each other, thus getting the best prices and terms for our clients. We then present these options to our clients so they can choose the best product at the best price for them. And this is why brokers are just better. But have you ever wondered how lenders are able to fund so many loans? From 2015 to 2019, U.S. loan originations averaged $1.8 trillion per year. Banks and warehouse lines simply don't have enough money to fund this many loans a year if the money would be tied up for 30 years. So how do they do it? First, we need to understand what gives a loan value. Loans have two potential revenue streams that we can place a value on. Those are no interest and servicing fees. In the simplest terms, no interest is the money an investor will earn from each mortgage payment made, while servicing fees consist of the fees that a loan servicer charges an investor to manage a loan throughout its life. However, like the lenders, investing hundreds of thousands of dollars into a single loan for 30 years is too risky for most investors. So how do we get around this? That is where mortgage backed securities, also known as MBSs, come into play. An MBS can be looked at like a box of loans that contains a giant pool of potential interest payments. These MBSs are created by the GSEs, Fannie Mae and Freddie Mac for example, and then are filled with loans that they purchase from lenders. The loans purchased by the GSEs are required to fit within strict parameters to reduce the risk to potential investors. Also, in order for it to be worth the risk to an investor, conventional loans with an LTV higher than 80 also require mortgage insurance, even though the borrower meets the strict loan requirements needed to fund the loan. Once the loan is purchased by the GSE, the lender recoups the original funds lent and can now go out and fund more loans. Meanwhile, the MBS is sliced into bite-sized chunks called bonds that investors can then purchase. Now, every time a mortgage payment is made on a loan within the MBS, the principal and interest that is owed to the investor is passed along. Once the original bonds are sold, the GSEs recoup their money and are then able to buy more loans to make more MBSs. These bonds can be bought and sold on the bond market anytime by any investor in the world. Unfortunately, just like there are no guarantees in life, the same is true for mortgages. Even the most qualified borrower can lose their job or encounter one of hundreds of other hardships that causes them to default on their loan. This is where loan servicers come in. Among the responsibility of loan servicers is to ensure that the properties are insured and have their property taxes paid to make sure the investor is protected. They are also responsible for collecting loan payments from borrowers and then passing on the principal and interest owed to the investor. But when a borrower is no longer able to make their payment, It is the loan servicer's job to try to work out an arrangement to bring the loan current. If the borrower isn't able to bring the loan current, then the loan servicer is responsible for minimizing the loss to the investor through any means such as foreclosure, short sale, or loan modification, to name a few. For these services, loan servicers charge a servicing fee that is paid by the investors. Loan servicers collect their fee from the mortgage payments collected before passing the rest off to the investors. Most lenders choose to keep the servicing rights of the loans they fund in order to collect this fee. However, servicing rights can also be sold to other qualified servicers at any time. Now let's talk about the investors that buy mortgage-backed security bonds. Most people would assume that it's large hedge funds or investment banks, and they would be right. But they are not the only ones. Mortgage-backed securities are purchased by a wide variety of investors such as pension funds, 401k funds, companies such as Apple, Google, governments such as China, Germany, and individual investors as well through services such as E-Trade and Vanguard. In our global economy, anyone and everyone is a potential investor. So when all is said and done, the answer to the question of who owns mortgage loans? The answer is the world. We hope this video helped you understand how loans are funded and who eventually owns them. Thank you again for watching, and we hope you will think of us for all your mortgage needs. We are TRG Mortgage Services. It's just math and science.